Hi, everybody. Jim Kruzan here, and welcome to the Capital Market Review for the fourth quarter 2025. In this report, we'll talk about the year, the quarter, and also the month of December. As we do every quarterly Capital Market Review, we come up with a theme, a song title that best reflects kind of how we are thinking about the market, kind of what feelings we have. And for this quarter, the song I picked was Land of Confusion, performed by the rock band Genesis, and it appeared originally in 1986 on their Invisible Touch album. And it truly is kind of a land of confusion. There's a lot of confusing data and a lot of cross currents. It's a little difficult to really get a good grasp on what's going on. And we'll discover that in the next 10 minutes. This presentation is an attempt to answer those questions about where we are and, more importantly, where we're heading. We've got to get a couple things right. Where we think we are in the economic cycle. We've had an opinion on that for the last several years following the economic data. And also what the Fed is all about. Are they loosening or tightening? And sometimes what they say and what is actually going on behind the scenes might be a little bit different. Our agenda is jam-packed. And over the course of the next 10 minutes, we're going to talk about three things. Kind of an economic overview. We'll talk a bit about market valuations. And then we'll end with a couple of positives, or at least things that worked well last year and seem to be continuing to work. As I've said often, there are a couple of potential outcomes to all of this. We'll continue to track the data. And eventually, the data will either show and confirm the weakness, and we'll see a recession and ultimately a drop in the market. Or the data will actually start showing some consistency of improvement, in which case we can pivot and adjust our allocations. In either case, we hope that we'll begin to see the market broaden out. And what I mean by that is it's been extremely concentrated the last several years, with most of the growth and a good deal of market valuation being concentrated among a very small number of companies, Meg 7 and otherwise. So the title was Land of Confusion. And here's why. A lot of the economic data that's reported regularly or monthly continues to show weakness. The most recent LEI that was released just last month continued to show a drop in the month of September, a drop that continues. And in fact, that report suggested that the most recent 6-month drop in the LEI was significantly greater than the previous 6-month period. So the second derivative or rate of change is also accelerating a bit to the downside, or at least as of the time of this report. All the while that's happening, we're celebrating a market that's at all-time highs. Yet the data is somewhat contrary to that. For example, if the market is so great, if the economy is so robust, then why are credit card delinquencies, those that are over 90 days old, are nearly 12.5% of credit card balances? That is a number that continues to increase. And we can kind of see why in the data. If we look at the data to the right, bottom, flows of early delinquency, we'll see over the last couple of years, they've all been rising. And here recently, a huge spike in student loan debt, or I should say defaults or delinquencies of student loan debt. They're now being forced to pay. And as a result, they're unable to, because they backfilled a lot of that extra money they didn't have to pay with additional credit card or additional timed purchases. And we're seeing household debt service, the chart right above it, continuing to rise as well. This is a result of a lot of people backfilling 0% mortgage rates or 0% interest rates with more debt. And now they're paying the piper because they're now paying a much higher interest rate for that. The unemployment rate has been bouncing all around. In November, it rose to 4.6 from 4.4. And I believe as of this morning, it dropped to, I think, 4.5 or 4.4 again. Take that data with a bit of a grain of salt, because a lot of it is a function of the denominator. That is the number of people out there really seeking jobs. Because of our immigration policy change, we're seeing less people seeking jobs. So what that does is that tends to skew the unemployment rate a bit lower than what it would normally be. That said, by the way, that looked like better data. That said, the trends look horrible. The jolt rate, those are people who are literally quitting their job before they find a new job. Those things tend to spike when there are plenty of jobs available. I can quit today and walk across the street and get employed. Those have been plummeting. At the same time, hires are dropping and have continued to do so over the last several years, and layoffs are starting to increase. I think one of the big reasons for that is labor force growth. That's the chart in the upper left-hand side. You'll see the dark gray or dark black bar. That's where growth is coming from. And right now, it's coming from all native-born Americans. We're seeing very little growth in the labor force in terms of foreign-born immigration. At some point, that has an effect on labor growth. It has an effect on GDP growth as well. Another thing that's awfully confusing in this land of confusion has been GDP. GDP averaged about 2% or so last year, started anemic. It actually fell, rose in the fourth quarter. This year, the expectation is about 2% over the course of the full year. At the very same time that's happening, and you take that as, oh, that's pretty positive, we're seeing a very robust deficit. We are borrowing money at a rate of just under $2 trillion a year, all of which is being added to our national debt. But the deficit itself, the size of it annually, represents about 7% of our GDP. Now imagine that. We are borrowing money at a rate of 7% of GDP, and we're leaching out about a 2% GDP growth rate. If that were some type of business proposition, it's probably something you'd pass on. Doesn't seem like much of an opportunity. That will have to be corrected at some point. Yet we celebrate high market values. And here's the reason why. We see an incredible, not ordinary concentration in the stock market, both in terms of valuation as well as earnings. Right now, the top 10 companies within the S&P represent 41% of the index. There are 500 stocks. When you buy the S&P, you think you're buying a diversified portfolio representing the total U.S. economy. The reality is 41 cents out of every dollar is going to 10 names. The more money going in, the more it gets concentrated, the higher the values, and it tends to skew everything much, much higher. And we see the same thing with respect to price performance. The bulk of the performance has been with a handful of stocks, and it has dragged the overall index higher. As a result, most traditional means of ascertaining valuation, Buffett indicator and such, are flashing caution or warning that these valuations are extremely high. At the end of the third quarter, the Buffett indicator was 230%. Historically, it averages about 70. So that gives you a sense for how high it is. Through Monday of this week, it was 220. Not necessarily coming down. Those numbers fluctuate quite a bit, but you can see it's really extended higher than we've ever seen before. And while a lot of people like to use that number, most academics prefer the Shiller index, which is cyclically adjusted for earnings, which makes more sense, and it's inflation adjusted. So you can look at valuations today and compare it to those to valuations in past times. And they hit this week nearly the highest value we've ever seen. The only other time it was higher was a few months prior to the peak of the dot-com bubble. It's actually much higher today than it was going into the Great Depression, which is really interesting because I'm reading that book, 1929, got it as a Christmas present. And there are certainly some similarities in terms of folks who are enthusiastic, let's say, about a handful of stocks. Why this all matters is at the end of the day, price matters. And when you're dealing with an environment with extremely high price earnings valuations like we have today, the forecast for the following 5 years in terms of earnings growth is really poor. We can see that in the right-hand chart. The x-axis is PE or multiple. The y-axis is return. And you can see where we are today, the little red triangle, and you can see the expected return off of that over the next 5 years is really quite weak. What normally happens is it's not that it becomes kind of a low return environment. What usually happens is over the course of the 5 years, you see a sizable drop, and then it takes the balance of those 5 years to dig back out, resulting in a nearly zero or very flat-like return over the full period of time. A couple positives, and I mean that from a market perspective, not necessarily what it's telling us about the economy, is the dollar's been falling. Now, generally, the dollar doesn't fall if the economy is robust. It generally falls when there's perceived weakness in the US versus elsewhere. But that has really created a situation where gold is outperforming, which is certainly a plus. It's an outlier. And the international markets are also performing and outperforming the US as well. We have driven quite a bit of our portfolio growth by having positions in both of those. And you can see from this chart, those gray bars are periods of time when the dollar is falling. And those purple mountain charts, those that are above the x-axis, are those periods of time when the international markets outperform the US. Happens every time the dollar falls. It's actually happening today. I think there's an error on that chart because the international markets are actually outperforming the US, at least in 2025. So that's something to consider. And going forward, international stocks, stock valuations, price earnings, price to value, dividend yield, all seem to be quite a bit cheaper than the US. An average of 12 times versus nearly 21 times earnings. So there might be some additional wiggle room. To just cap things out, the S&P was up about 16%, but the international markets last year were up well over 27, and gold was up over 61. So a 60-40 traditional balanced account, Goldilocks, not too hot, not too cold, was up about 11. And a lot of that was because of the cap weighting. The S&P, as I mentioned, was up 16, but 9% of that 16 was directly related to Mag 7. And if you decided to steer clear of those really expensive stretched stocks, and you were taking an equally weighted perspective on the S&P, each stock amongst the S&P being weighted the same, that 60-40 balanced portfolio would have been up about 7%. So that's where we saw things as of the end of last year. Happy New Year to all. We will talk again at the end of January to see how the year starts. If you have any questions, please reach out. Thank you so much. Have a wonderful year.